This is Ingo Windsor at the Local Market Monitor. Today, let me show you how the investor's meta-analysis can be useful to real estate brokers, particularly those who have or want to have clients that invest in rental property. Many brokers are happy with your traditional broker business, where closing the deal is the goal, and you may get repeat business years later when that home is again for sale. But some brokers realize there will be more renters in the future and more investors in rental property. For those brokers, traditional business can remain the mainstay, but investor business can be a growing source of income, especially because satisfied investors use the same broker again and again. So what's different about being an effective broker for investors, and how can the investor's meta-analysis help you? In a word, analysis. You'll need to learn how investors calculate returns on a property. That's fairly easy. What's more difficult, and much more important, is how to identify the risks of investing in a particular property. That's where analysis comes in. A potential homeowner mainly cares about what price they have to pay today, but an investor cares mainly about the rental income they'll get in the future. If you can help an investor identify the risk to their future income, which quite frankly may cause an investor to back out of a possible purchase, you'll become a trusted advisor, not only to that investor, but to others who hear about you, and you'll get more and more business. Investors face all kinds of risks, from upkeep of their building to financing arrangements, but the uncertainty of future income is their main risk. That risk comes from both the future performance of the local economy, will it be good or bad, and from the actual structure of the local real estate market. First, the economy. How strong is the current demand for housing, and how strong will demand be in the future? Home prices can tell us a lot about the first, jobs about the second. And we also need to know if the local housing market is currently overpriced. That doesn't happen often, but when it does, your investor needs to know. So let's look at those three things. Here's the first page of our investor's meta-analysis for Albuquerque, New Mexico. There's a lot of stuff here, but we only need to look at the pictures, those three charts in the middle of the page. The left chart shows the annual increase in home prices in Albuquerque over the last 4 years. You can see that it's recently been around 6%, which is pretty good. The increase in home prices is a very reliable measure of demand for all housing, including rentals. That doesn't mean rents have gone up 6% too. They typically rise less than home prices, but it means that demand for rentals is good right now. The middle chart shows the annual increase in jobs in Albuquerque by month. Since the start of the pandemic, there's a loss of jobs, as is true in most markets in the country. Normally, if jobs grow less than 1% per year, it's a sign of economic weakness. That means poor demand for rentals in the future, because jobs create demand for housing. Right now, we don't know what will happen when the pandemic is over. With luck, jobs in Albuquerque will again increase at the rate before the pandemic, which was a modest 1.5% or so. But we don't know how many of the lost jobs will be lost for good. So right now, the job situation means there's more risk for investing in rental property in Albuquerque. The last chart, the one on the right, shows the level of home prices and a line of red dots that show where local income says prices should be. If actual home prices are much above that line, the market is overpriced and your investor may be paying too much for a property. These are the rules of thumb. If home prices are increasing less than 4%, current demand is weak and there is more risk for investors. If jobs are growing less than 1%, future demand will be weak and there is more risk. And if home prices are more than 20% above the red line, the market is overpriced and there is more risk. We sum up these risks in a single risk rating, which for Albuquerque right now is medium. The rating can be high, medium, or low. For comparison, let's quickly look at a couple of other markets. Here's Dallas, where home prices have been trending lower. Job growth also is negative, and the market is in fact overpriced. Overall, the risk of investing in Dallas right now is medium. In Las Vegas, you see what a boom and bust market looks like. Like Dallas, this market also is overpriced, but the job situation is much worse. So our risk rating for Las Vegas is high. The local economy is a force that affects all housing in an area, but the structure of the real estate market in particular zip codes can reveal additional risks that can be even more important. We get at these two possible risks with two stats particular to zip codes: the ratio of the average home price to the average annual rent, and the range of monthly rents where renters are most concentrated. Let's look at the price-rent ratio first. Here's a page from our meta-analysis for Albuquerque. There's a lot of numbers here, which at times can make my head spin, but note first the very left column, which lists the zip codes in the Albuquerque area. The government does a tremendous job collecting this very detailed information. For each zip code, we can see how many people live there, what percent live in rental property, that renter concentration range we'll talk about shortly, the average monthly rent by forecast, the average home price in thousands of dollars, the ratio of average home price to annual rent, which we're discussing here, and 3 years of actual home price increases. Aside from my forecast, these are government data. You can find them yourself if you want to. Let's focus on the home price to rent ratio. The circle shows a group of zip codes where that ratio varies from 18 to 28. The US average is typically around 20. The importance of the ratio is that it tells us what types of real estate investment are favored in a particular zip code. Consider the ratio of 28 in zip code 87106, which is in the city of Albuquerque itself. It says that in this zip code, home prices are much higher than rents. If you buy a single family home to rent out, it will be too expensive for most of the renters who live there. A more favored investment, by which I mean a less risky one in this particular zip code, is apartments, or a single family home that you subdivide into several rental units. On the other hand, in zip code 87110, where the ratio is 18, there is a good overlap of home prices and rents. Here you can more easily rent out a single family home, or you can subdivide one, or upgrade it to a higher rent, or for resale, or you can invest in apartments. You'll see some zip codes on this page with very low ratios where, to be honest, I don't know what's going on. But overall, here are the rules of thumb. If the home price to rent ratio in a zip code is above 22, apartments and subdividing are favored. If the ratio is below 16, straight single-family rentals and inexpensive upgrades are favored. And in between, all options are equally favored. Now let's look at that second important feature of local market structure, the concentration of renters. Here's what I mean by that. It's data from the Census Bureau for zip code 20171, Herndon, Virginia, which is just outside Washington, D.C. It shows how many renters are in the monthly rent ranges listed on the left. Only 5 pay between $800 and $900 per month. 170 pay between $1,000 and $1,250 per month, and so on. The ranges are not all the same size, but it's clear that the largest concentration of renters in this zip code is in the range of $1,500 to $2,500 per month, highlighted in red. Why is this important information? Because the average renter moves within 2 years. I'll repeat that. The average renter moves within 2 years. When your tenant leaves, you'll have a much easier time finding a new one if the rent you charge is in that $1,500 to $2,500 range. If your rent is above $3,000, for example, very few people pay that much in this zip code right now. You'll be less likely to find a new tenant, especially during economic slowdowns. Does this mean you shouldn't invest in such a property? No, it could be a great investment, but you need to know how far this property is from the range of lowest risk. What about below the largest concentration range? Here, your risk comes not from the lack of tenants, but from the fact that tenants in the lower rent ranges are more likely to have financial difficulties that can affect your income. Here are some actual rent ranges in zip codes in Albuquerque. Some are fairly wide, like zip 87031. Some more narrow, like 87020. Here are the rules of thumb. Above the largest concentration of renter range, few renters are found, especially in times of stress. Below the range, more renters have financial difficulties. Within the range is the lowest risk. To sum up, you, the real estate broker, can provide valuable information to your investor client by using the rules of thumb about the local economy, the price-rent ratio, and the renter concentration in specific zip codes. This is pretty easy. It will show your client that you are concerned about the extra risk they may be taking on a particular property and that you have insights into the local market that other brokers do not. Sometimes an investor is looking at a specific property. Sometimes they will ask where the lowest risk options can be found. In either case, your knowledge will separate you from most brokers. You will be the trusted advisor. Our investors meta-analysis is available for any of 200 markets across the country. Thanks very much for following along. I'm Ingo Windsor.